All right, so a tale of two markets today. A nice, good rally, 2-3% rally, depending upon the index. Kind of the rally we've been expecting going into the FOMC meeting, and the exact opposite coming out of it. And so we're going to talk about how the market moved today, how it changed some of these indicators we're looking at. What do we expect now? Now we've had some more weakness. Are we going to push to new lows? Have we hit any of these moving averages yet? Where's the resistance in the short term? So we'll break all that down, talk about what's driving the price action. Of course, it's the FOMC. We've been talking about that a lot. I went through Twitter and in these videos, we've been talking a lot about the historical context of what the Fed's doing. Today's my trading room. We spent quite a bit of time today and yesterday talking about context of what the Fed's doing and how it is a little different than prior tightening cycles. So we talked about that today in the video. We also take a look at a trade similar to my last trade idea, looking for a stock that in this case has some relative strength. Is through its earnings season and is stuck in a range. So we're going to talk about trading that and why that might be beneficial for us. So let's go ahead and get started. Today is Wednesday, January the 26th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we're still well down here. We were at the 38% retracement level today of this decline. We were in retracement mode a couple days ago. We got out of it. We're back down below it now the last 2 days. So pretty decent sized ranges, but we're not getting up above these resistance levels, and we're closing at bearish levels. Intermediate line still in the reversal zone. We're still more than 6% below the moving average. So obviously correction mode here. The near-term line is still rising, though it doesn't look like it's going to get to bullish territory yet. So we'll see how tomorrow, if we trade in the upper part of today's range tomorrow. Excuse me, momentum line is down. If we take a look at some of these other indexes, look at the Dow Jones. Looks very similar. Again, you can see we are in, just like all the rest of them, we are no longer in bullish impulse mode. We are in bearish impulse mode. But unlike the S&P 500, we are not below the 23% line. We actually did get above the 38% level, but again, still really easily far down below moving average. We have dark pink shading and a red line. So we are obviously in bear market mode there. If you take a look at the Russell 2000, same thing, right? Almost looks exactly the same. We are 8% below 30-day moving average. Have been below it for a while. We are still not above the 23% line. We are below the 38% retracement of that one significant intermediate move that we had. And then, of course, here's the 23% line of that big COVID rally. So well below that, not anywhere close. And then finally your NASDAQ 100 again looks very similar. Near-term line in neutral territory, still below the 23% level, below both this current one and that long-term COVID, closing below that for the second consecutive day. So the expectation is for short-term, near-term improvement to resistance and nothing more than that. Right, and trading within the range of Monday's lower shadow, but I don't necessarily think we'll push down through the new lows yet. I think we'll still get a near-term rally first into bullish territory. Of course, the question will be, where does the near-term line peak when we get that near-term rally? Again, for some context on where that near-term line can peak, let's go to the SPX. Let's go back to that fourth quarter of 2018. You can see while we were in bearish mode, the near-term line did get up above 90. So it can get into bullish territory and get above 90. The question, of course, is where will it peak relative to these other moving average resistance levels? So that's kind of what you watch for now. The near-term line will rally up to bullish territory. It could rally up above 90 and look really strong, but not necessarily. In fact, this last near-term peak, we peaked up here, and the decline started after the beginning of the year. That near-term peak got the near-term line above 90. So, that one, it was a bearish near-term peak, but it still got above 90. So don't be surprised if we don't get something like that again when we come off with the volatility levels at pretty significant high points. Let's take a look at the long-term chart. You can see now we are below the 40-week exponent. The Hakinyashi close is below the 40-week exponential moving average for SPX. It's pretty significant there. Obviously, we still have a positive differential, but we are in divergence mode, right? That's what when you are below the moving average, right? And let's look at the regular candle. When you are below that long-term moving average, the long-term number inside this MACD, and that's what the PPO is. It's a normalized MACD. So when you're below that moving average, we are in divergence mode. Again, for context of other periods of time, COVID, there's 2018. We got below that moving average. We were in divergence mode until we got back up above it, right? And we were back into bullish divergence mode. So, we saw that in 2018. We saw that in 2015-16. We got below that moving average. We were in divergence mode. Below brief bullish divergence before being back in divergence mode. And that's where we're at again right now. We are below that moving average, well below it on the Russell 2000. If you notice here, we are well below it there on the Russell 2000. As you can see, again, getting below that 23% retracement of the long-term move, that 38% line of this one significant intermediate run that we had there. So, and then of course this one is, I'm going to actually change this one to highlight that it's the bearish run. This is the retracement of the bearish move right now that we're on, the red line. So that's what that, but look at it, we have a negative differential, like the PPO, the 10 week is below the 40 weeks. We have a negative PPO now. This is the first one that has a negative PPO. The differential is pretty significantly large. The candle, the size of the Hakinyashi candle, let me go back to the regular Hakinyashi. It's pretty sizable. Again, we've seen this before in other instances. That's not the case in some of these other indexes yet. The Nasdaq is, like the Nasdaq is also now, it got below it last week. It is below it this week again. There's your long-term moving averages. Pretty significantly large Hakinyashi candle, and we're still got a positive PPO, so it's still not negative yet. You can see, like, it didn't get very negative for very long during the COVID drop. That's how sharp the down and the up was on the COVID drop. But obviously this is a little bit different of an animal than what we're seeing on those levels. If you look at the 3 green arrow charts, we're light pink shading all across the board, which means we have 3 red arrows everywhere. The stochastics is probably going to be the one that gives you a green arrow first, but the stochastics is in strong bearish levels, below the reversal zone on all of these. So very strongly bullish across all those levels. Looking at the moving averages, you can see we're still below the 200-day moving average on SPY. The MACD is still diverging. We're still well below the 8 and the 17. We did get up to the 8 on an intraday basis on the S&P and small cap stocks. A little bit of an engulfing pattern again. So, but I still think that we're going to make a run in the short term up into these levels, up to the 8, up to the 17 days. The market digests what the Fed announced today. When the market's largely been expecting what the Fed announced today. And you can see here, we also got up to the 8-day again today on the Qs. So still well below the 17. The Qs is well below the 200. Remember, the 30-day just crossed below the 50 on the Qs. The 30-day is just barely crossing below the 50 on the SPY. And of course, the 50 has crossed below the 200. The 30 crossed below the 50 way over here. The 50 is now crossed below the 200. And the 200 is about to cross below the point of control. So, we've got, some pretty significant downside moves. Again, one of the reasons why we've been hedged against the Russell more than the Qs right now, because the Russell has been more bearish. And it's got a very, very poor margin of safety. And it still has a very poor margin of safety. Even if I were to go out 5 years on the volume here, that your next layer of supports, those pre-COVID highs, it's actually also the late 2018 highs. That's your next layer of support. That's down about 175. Of course, you have Fibonacci support at 187, but that's how far down we can go. Again, filling in the rest of the gap between the 40 and the 50-week exponential moving averages. You can look at the SPY's got a little fat finger going on there. If you look at SPX, you can see that it's just barely below the 50-week. Look at the Nasdaq. It is not just barely below the 50-week. It is actually below the 50-week, and you can see that how the weekly MACD is really dropping. We are in divergence mode We are in fill in the gap mode. You can see we filled in the gap COVID there on the NASDAQ. We filled in most of the gap in 2018. So we are in fill in the gap mode, and the gap is about as big as it's been. I've shared with you that before. Looking at the RSI and the CCI, you can see we're still at strong bearish levels, hence why I still think there's some short-term bullishness still ahead of us. The CCI is coming up off it's still in bearish territory there too. Looking at the directional movement index, I mentioned to you in the tweet that when you get the negative indicator up this high, it typically marks the beginning of bearish moves, like extended bearish moves, where we go up and down, but we stay below these moving averages for an extended period of time. So I still expect that to be the case there. We are in these extended bearish. I'm expecting we're starting an extended bearish move. There will be some ups and downs though, as we navigate that on SPY. Of course, when you look at the Qs, same thing. IWM, same thing. You can kind of see just we are strongly bearish. We are starting bearish moves. We have strong bearish declines going on here. We just haven't had these. Again, outside of COVID, we haven't been this bear. I mean, look at 2018 is about as deep as we got here. Even look over there at 15 and 16, far over to the left. You can see again, and it also puts in this to shows you how bearish that COVID drop was. That it got even dramatically more bearish than where we're at now, and you can see that we could be here for a while. Like there's the bearish runs. We had some bearish run. We got above 80. We stayed there for a little bit of time. We stayed here for a little bit of time. In 2018, we stayed here. We got up and came down, but then stayed. We didn't get a good bullish move coming out of it. So not even an intermediate bullish move to come out of that. So that's kind of what you watch for here on this particular chart. And of course, when you look at your Bollinger Bands, especially with the Keltner channels, let's pull up the Keltner channels here. We are still out between them. Remember, when you're between them, you're trending, and we're still easily between them with a very, very high bandwidth. That bandwidth for you can compare apples to apples in that bandwidth. We were higher in 2018. We were a little bit higher in 15 and 16. Obviously, much higher in COVID, but that bandwidth is getting relatively big, and again, typically will lead to a bottoming here in this momentum to the downside. And again, I don't think it bottom will necessarily lead to a strong rally. I think it actually will lead to a nice, good opportunity for some condor trades with the few days left we have for that entry window into February expiration. And then again, it'll be once we do get the rally, short-term rally, it'll be a good opportunity to trade bearishly the next leg lower. However long or far that next leg takes us. Finally, let's look at the volume today. Whoops, not there. The intraday move. You can see we did gap. You can't really tell that fat finger price. It's kind of throwing everything off here. Given TD Ameritrade's, they don't really fix their data, so we have to wait 20 days for that to go off on this intraday chart. But you can see, without that, you can see there's our gap, our opening gap, and we did fill that in. We did get a lower high, and if you look at yesterday's low being that low point, 427.15, it's about an equal low. We did close below yesterday's high, but not below yesterday's low point. So obviously not a very bearish day from that perspective. If we take a look at the Qs, now we don't have that fat finger. You can see, same thing. We did not close below yesterday's low point. We did get a higher high too. So we did close at the low, so there is a bearish bias, but we didn't close below the low. And we did get a higher high. So it could have been a lot more bearish than it was. We also are below last week's low on small caps. We are also below last week's low on the Qs. So but I expect that I wouldn't be surprised if we got back up above those lows, both those weekly lows, by the end of the week. I think we'll knee jerk this and probably grind to the upside through tomorrow and Friday on a very near term basis, right? Before we get a new selling peak that we can sell into. Looking at today's volume, you saw on this chart that the volume is above average, 184 million. The trading range is at 15 points. over 15 points. So when you put those numbers into perspective, 184 million obviously is well off this chart. 15 points is well off of this chart too. I mean, that's 1% is 4.33. The ATR now is almost up to 9. That's more than 2%. So we are at levels where we can kind of like where a lot of the thrust of the weakness might be behind us. Doesn't mean that this is the lowest point. It just means that the thrust, like the hardest selling, may be behind us. With that, keep that in mind in terms of what I just told you there. But also keep in mind too that the VIX didn't really spike. We never did get. We got up to 105% early yesterday or Monday, but we didn't stay there. We still haven't closed above 100% any of these days. Today was probably the highest level of where we closed. We closed at almost exactly at 100%. The VIX was at 31.96, and VIX 3M was at 31.95. So just a smidgen above 100%. But this is the closest we've closed. So we still haven't gotten a VIX spike. But we have gotten some big ranges and moves. Like the ATR is already over 2%. That tells me that, like 2018, where you kind of got a little, you had a big spike there in early 2018 and then a little one later. Here, you got the big spike late. You got a little bit of one early, even more than what we got now. But then we kind of were grinding around, and then you got that big washout sell late. So you didn't get the washout early like you did in early 18. You got the big washout late, and I think that that's coming. So I think you'll we've got that big thrust of selling here now. Again, to compare to 2018, you got your big thrust of selling. Boom, right? Where'd it go? Your big thrust of selling. I think this is the bearishness, right? We might get a little bit lower, but it seems like we got that biggest thrust over with. Now we kind of go up and down, right? We stay down below these moving averages, but we kind of go up and down. And then we get the big washout late, and that's kind of what I think will happen in this particular go as we eventually move down towards those long-term Fibonacci retracement levels and find some good support and then a good move off of that eventually once that comes, which again I expect will be probably about another month or two later. Doesn't mean that we'll have a month or two without any up days. It doesn't mean we'll have a month or two without any really good up days. But it means that we'll have probably about a month or two before we get back to dark green shading and a green line. We're probably not going to get that anytime soon. So what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that would suggest why you're either a lot more bullish than I am or a lot more bearish than I am? All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here on the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. One, you like our video today. Two, you want us to do another video again tomorrow. Quick way to give us feedback and let us know you like our stuff. Of course, if you don't like it, you don't have to click on anything. You don't even have to watch. Also, while you're down there, comment. What did you get out of our videos today? What stood out to you? What questions or comments you have about anything I brought up? Post those in the comments section. Join our website at marketscholars.com. There's a link popping out up there. You can subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us here on our blog, check out some of these other things over here on the right. You can see our Market Outlook live video. Click on this icon right here. It takes you to this page. Here's where I review all the trades we've been doing in these videos to see whether we should stay in them, get out of them. We talk about managing, so that's what we do in this. We also put on today's trade already before the market closed, so you can see that there. You can also get to it by coming up here to the top and clicking on Market Outlook Live Trade Review in that menu. Come down here, you can see our upcoming classes. Click on View More right there. You can see our calendar with our upcoming classes, as well as all of our recordings, almost 4 years worth of recordings down there. Come down to the bottom, click on that heart icon. It opens up this tab. Hit that like button. We had 20 retweets, which was quite a bit. And we also had 95 likes, so really appreciate that. Almost got to the 100 mark, so let's see if we can get there on this one. You can do the same thing for Facebook. Click on that thumbs up icon, takes you to this tab. Hit that like button. We only had 14 there, so the more we can get, the more it helps us because it gets our content out to all of our people that follow us. That's how their algorithms work. We also helps you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. So the more you engage with us, the more you're able to keep seeing our stuff all the time in your timelines. All right, now let's take a look at what's driving the price action today. And early today, going into the FOMC meeting, you can see the Qs were strongly bullish, up 3%, 2%. Remember, we talked about that. We're still going to expect to get 1-2% rallies here. And we had that going in the FOMC meeting. Gold was way down more than 1% because of the strength in the dollar. Long-term bonds were down. Even immediately after the FOMC meeting, long-term bonds were down. Long-term bonds actually stayed down and got even worse by the end. Gold also stayed down. The dollar rallied strongly, put a lot of pressure on commodity prices, and of course put a lot of pressure on equity prices, especially emerging markets. Emerging markets finishing today with the biggest losses, developed markets kind of matching where the S&P was. And you can kind of see, if I were to take a look at the different the major global economies here, to see how they kind of perform, how their ETFs perform. You can see developed markets were actually positive coming out of the FOMC. Russia and China were your biggest losers. Korea, Japan, India also down there. So Asian really getting hit hard, whereas your European developed market areas, as well as Brazil, holding up very, very well. They were your biggest winners going into the FOMC. They maintained. In fact, Canada and the UK were actually underperforming the S&P, but then by the end of the day, they filled in that gap, and then all these other areas still finished really bearish. The major emerging market players, and again, a lot of that goes to the strength that we had in the dollar today. If you take a look at UUP, really kind of breaking back out up above those moving averages. It was kind of sitting at resistance at the 30 and the 50, but then today a pretty significant breakout. It'll be really interesting to see if this ends up being a breakout, a true breakout, or a fake out move where you entice a lot of dollar bulls to get in only to fake them back down. We saw that in IWM. Big classic recent example. So we'll see if that ends up being the case again. If you look at TLT, I mean, it is bearish. It is well below its 200-day moving average and staying there. The 30-day is below. It is in bear market mode. IEF is even worse. The IEF is actually the one that is tied to the 10-year yield. It's really dropping. It's significantly below the 200 point of control. It's below the 1-year value area. So it's really having a hard time. Commodity prices we talked about gave up some of its strength. But look at that. I mean, commodity prices actually hit a high. Remember, they hit their highs last, so they're still going up even though stocks have already peaked. We haven't even hit convergence mode yet. The MACD is actually still above its moving average, even if the stochastics isn't. We got a lot of volume today, so we'll see if that ends up being kind of a washout move for commodity prices. Bitcoin started the day really strong, got all the way up to its 8-day moving average, is not finishing the day really strong, finishing at the lows of the day with a lot of volume itself too. Again, the 30-day is already well below the 50. Now the 50 is moving towards a death cross on the 200. Last time we had a death cross on the 200 and the 50, the 200 wasn't dropping, right? You see how we had the death cross, the 200 was rallying. If I were to go back as far back as the futures contract takes us, we had a death cross over here, and the 200 was still rising. So this didn't last very long. But then once the 200 rolled over, we stayed down for a little bit longer. We had this next leg lower, and then we took off back to the upside. So again, unlike here, we're about to get a death cross, but the 200 is already falling. So a little bit more bearish than your typical death cross. Because that 200 is not rising anymore. So keep that factor in mind when we're talking about how bullish some of these different asset classes, these risk asset classes are. I mean, the dollar's strong. Gold pulled back, but still is dark green shading the green line. Of course, long-term bonds are falling. There's the 10-year yield rising. Commodities still bullish, but equities, global emerging markets and developed markets are really struggling. Silver's not really able to get going. Copper's not going anywhere. Bitcoin's dropping. Bearish all across the board here. If you look at today's sector comparison to see how things perform today, you can see it going in. XLK and XLY were your big winners. XLK still actually held up pretty well. It's right in the middle of its big earnings season week here with Microsoft and Apple. But you also have financials doing pretty well too. That's going to be a factor of our trade idea today. And then you also have energy outperforming, and then down the bottom, your staples and utilities were underperforming. They actually still underperformed the S&P by the end of the day. So it really wasn't a risk-off day when you look at it from that perspective. They didn't drop very much from these highs, not as much as some of these others did, but by the end of the day, they weren't necessarily really outperforming either. Again, that's why I think a short-term low is in place here. And finally, when you look at the 12 grid for the sectors, you can see, they all look exactly the same. Dark pink shading and a red line everywhere except for energy. Right, that is very common of a pullback. Right, I've told you before, when we are in intermediate decline, now market sentiment decline, correlations get close to 100%. So they will all look the same, and that's kind of what we see. They are almost all looking the same from a sector standpoint. I didn't show you the 12 grid for these major economies. But there's a lot of dark pink shading and red line across the board here too. So this is a global phenomenon. Yeah, energy is doing its own thing. Yes, Brazil is doing its own thing. But for the most part, this is a global situation. There's going to be some better margin of safety in these emerging markets that had a weak year last year. I mean, they might still go down. They just won't go down as much. But everything else, and look at Korea, which is, again, a reflection of global economic growth expectations, a proxy for that. It's really getting hammered, 13% in the last 3 months. All right, now let's take a look at our trade idea of the day. And I told you the financial sector's held up really well. I want to take a look at Morgan Stanley. It's through its earnings season. You can see it's really sideways. Look how sideways that action has been. The MACD, you're not really getting extended periods of dark green shading, green line, or dark pink shading and red line. You're just fluctuating between one and the other. The MACD, the intermediate line has pretty much stayed between 20 and 80 this whole time. Brief periods in the bullish territory, brief periods in the bearish, but neither reversal zone. We're not hitting either, brief a little right there, but nothing significant. We're not really getting to either reversal zone. We got a slight bullish bias right now, but nothing significant. No breakout signal in the least bit, right? And you look at this big convergence we have going on. You can see what it looks like on this chart. These long-term moving averages have been really just going sideways here. In fact, all the moving averages except for the 200 all traded inside of today's range, and today's range was actually below the average. So this is a very sideways move. We're centered right on the point of control. You can also see it here on this chart, centered right on the point of control here. Around the biggest volume node, but not just like a little tiny one, but there's a good chunk of price all around this volume node here. So, but all these other oscillators look very neutral. The DMI looks, the DMI looks really neutral, very, very low ADX there, especially considering the rest of the market. The Ichimoku cloud's very flat. We're trading kind of right around it again, today's range kind of dissected the whole cloud, and then you look at like the RSI and the CCI, and it's not doing much of anything either. Very neutral. In fact, it's pretty much on 50 and pretty much on 0. So you can't really get more neutral than Morgan Stanley right now. Hence, the trade we want to take a look at is doing an iron condor spread. So we're going to come over here to the low 20 deltas, sell the 92, buy the 90. We'll sell this was a lower 20 delta when I first looked at it, but we'll sell the 106, buy the 108, and we'll see where we end up. We ended up getting, I believe, 60 some odd cents out of it. We did a full position size. Those break-even lines right there, that's what these lines are on the chart. So when you look at these lines, there's our break-even. So in fact, you can see we've had, most of this one, but 1, 2, 3, 4, 5. Most of 6 expiration cycles have traded inside of these break-even range, and it doesn't look like we have anything necessarily that's pushing it out yet. And if we do get a breakout to the downside, for an example, then we're going to have a really good bearish directional trade to come out of it. So we're not quite there yet. We'll watch it really closely for any kind of breakout signal, but in the meantime, until it does, we'll just try to take advantage of the sideways action. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel as well as our website at marketscholars.com. Click that thumbs up icon down below. Like us on Twitter and Facebook as well. Comment on the video. Have a great rest of your day, everybody. Wednesday night, and we'll see you all next time.